74.22 million troy ounces. That is how much gold China's central bank now officially holds, as of this morning, Saturday, March 7th, 2026. And they just confirmed in a report released hours ago that they added more in February, again, for the 16th consecutive month. Not 12 months, not 15 months, 16 months in a row, the People's Bank of China has been quietly, methodically, relentlessly vacuuming up physical gold from global markets, and almost nobody in mainstream media is connecting the dots on what that actually means for you. Meanwhile, gold itself is sitting at roughly $5,152 per ounce right now as I'm recording this, up approximately $66 in just the past few trading sessions, bouncing hard off its $5,071 low earlier this week, fighting back toward the $5,200 level. And if you zoomed out and told someone 12 months ago that gold would be at $5,100 an ounce, they would have laughed at you. A year ago, it was sitting at around $2,900. That's not a misprint. Gold has risen nearly 75% in 1 year. And the PBOC just told the world they want more. I need you to stick with me through this entire video, because what I'm going to show you is not a prediction. This is documented data, official filings, central bank reports. And by the end of this, you'll understand something that very few retail investors have pieced together, which is that what China is doing with gold right now has only happened a handful of times in modern history. And every single time it happened, it preceded a fundamental restructuring of how global wealth was stored and transferred. Let me start with what dropped today, because this is the anchor of everything we're going to talk about. Bloomberg reported this morning that the People's Bank of China extended its gold buying streak to 16 straight months in February, pushing its total holdings to 74.22 million fine troy ounces. The previous month, January, it was 74.19 million ounces. Before that, December 2025, it was 74.15 million. You can track this yourself on the PBOC's official reserve data, which they publish monthly on the State Administration of Foreign Exchange website. Now, 30,000 troy ounces per month, that's what they've been announcing each month, might sound like a small number when you say it fast. So let me translate it for you. 30,000 troy ounces of gold at today's prices is approximately $155 million every single month, like clockwork. And that's just the officially disclosed amount. We'll come back to that distinction in a few minutes because it is critically important. But here's the piece that should stop you cold. When you look at what 74.22 million ounces actually represents in terms of dollar value, you're looking at a gold reserve worth roughly $384 billion at today's prices. China's gold reserve is now worth more than the entire GDP of countries like Sweden or Austria, and they're not done buying. Now, before I go further, and I know some of you are brand new to this channel, and maybe you found this video through the PBOC news today, let me be clear about what this channel is and isn't. I'm not here to tell you gold goes to $10,000 next week, or that the dollar is collapsing by Thursday. What I do is go through publicly available data, official reports, central bank filings, exchange data, treasury figures, and help you understand what's actually happening beneath the surface of the headlines. Everything I'm showing you today, you can verify yourself. I'll give you the exact sources. And for those watching who haven't subscribed yet, my analytics tell me that roughly 3 out of 4 people watching this right now are not subscribed. If this kind of evidence-based analysis is cutting through the noise for you today, hit that subscribe button. That's how I know who the core community is here. It also helps the algorithm show this content to more people who need to see it. Okay, back to the data. Here's the historical framework you need to understand what China's doing, because this isn't new. It's been done before. And when you see it from that perspective, it stops looking like a random news item and starts looking like a chapter in a very well-worn playbook. Let's go back to 1944, the Bretton Woods Conference. 44 nations sat down and decided that the US dollar would become the world's reserve currency. But they only agreed to it because the dollar was directly backed by gold, and the United States held the largest gold reserve on Earth. Roughly 70% of all the world's monetary gold was sitting in American vaults. That gold backing is what gave the dollar its credibility, its gravitational pull, its monopoly on global trust. Fast forward to 1971. Nixon closes the gold window. The dollar is no longer redeemable for gold. And for the next 50 years, the United States runs the world's financial system on something that's essentially backed by faith, military power, and the fact that oil was priced in dollars. That worked. For a long time, it worked remarkably well. But here's what happened quietly in the background over the last decade. Central banks, not speculators, not retail investors, not hedge funds, Central banks started buying gold at a pace not seen since before Nixon's fateful 1971 decision. The World Gold Council data confirms that in 2024, central banks globally purchased approximately 1,037 tons of gold. That's massive by any historical standard. And in 2025, despite prices surging to records, that number remained elevated, still around 863 tons for the full year. Now let me show you something specific about China that I think is the real story here, because the raw tonnage numbers only tell part of it. In May of 2024, the PBOC paused their gold buying. They had been on an 18-month buying streak and they just stopped. Markets noticed. Gold dipped. Analysts speculated. And then 6 months later, November 2024, they started again. And they have not stopped since. 16 consecutive months and counting. Why does that pause and restart matter? Because it tells you this isn't reactive. They're not panic buying when markets get scary. They're not chasing momentum. They paused, evaluated, and made a strategic decision to resume on their own timeline. That is the signature of a long-term, deeply deliberate reserve restructuring program. This is a nation with a multi-decade plan systematically reducing its exposure to the dollar and increasing its exposure to a physical asset that no government can print. The World Gold Council's January 2026 update out of Beijing notes that the PBOC pushed holdings 1.2 tons higher to 2,308 tons in January alone, with gold now making up 9.6% of China's total reserve assets. Let me put that in context. The United States holds gold at roughly 65% of its total reserves. Europe's major central banks range from 40 to 70%. China, at 9.6%, still has an enormous amount of runway to buy. If they wanted to even reach 20% gold allocation, still well below Western norms, they would need to purchase many hundreds more tons. The buying is nowhere near done. But the PBOC story, as important as it is only one layer of this. Because what happened to the gold price this week didn't happen in a vacuum. Let me walk you through the sequence of events, because the timing here is extraordinary. On February 28th of this year, a joint U.S.-Israeli military operation was launched against Iran. The strikes reportedly targeted senior leadership in Tehran, and reporting confirmed the death of Iran's supreme leader. Iran responded with Operation True Promise 3, ballistic missile attacks aimed at Israel and U.S. military installations across the Gulf. And then, this is the piece that sent gold vertical, Iran's Revolutionary Guard Corps declared the Strait of Hormuz closed to shipping. Think about what that means for a moment. The Strait of Hormuz is the single most important maritime choke point on Earth. According to U.S. Energy Information Administration data, approximately 20% of the world's daily oil supply flows through that strait. When Iran announced the closure, oil prices surged 13% in a single session. That's the kind of move that ripples through every supply chain on the planet. Inflation expectations spiked immediately, and gold, which has historically been the first major asset to reprice when the world enters a new phase of instability, lit up like a signal flare. So here's what the gold price did in sequence, and I want to walk through this precisely because the numbers tell a story. Just a year ago, gold was around $2,900 an ounce. By late January 2026, it had screamed to an intraday record of $5,602.22. That's the all-time high set on January 28th, confirmed by multiple data sources. Then it pulled back as the Kevin Warsh nomination for Fed chair rattled rate cut expectations. Gold dropped, consolidated, found support just below $5,000. Then, February 28th, the Iran operation begins. Gold surges. By March 3rd, it hits an intraday high of $5,417. Then it pulls back again as the dollar strengthens, and traders start pricing in the possibility that the Fed might actually have to raise rates to combat inflation from $120 oil prices. Gold drops to $5,071 on March 4th. And then, this is where we are right now, it bounces, hard, back up through $5,152 and pushing toward $5,200 today as the PBOC data hits the wire. Notice what just happened. Gold dropped, found buyers, and bounced. On the same day that China confirmed 16 months of consecutive purchases and 74.22 million ounces of total holdings. That is not a coincidence. That is the market seeing the structural floor and responding to it. Now let me add another layer here, because I don't want you to think this is just a China story or just a Middle East story. These are two pieces of a much larger mosaic. Peter Grant, vice president and senior metal strategist at Zaner Metals, was on record this week saying, and I'm paraphrasing his words here, that as long as the war with Iran is ongoing, gold will remain fundamentally supported, and he remains bullish, expecting new all-time highs. Meanwhile, ING Bank's analyst put out a note this week confirming that central bank buying remains strong and that even if Middle East tensions stabilize, the structural drivers for gold suggest downside should be limited. And then there's JP Morgan. Now, I don't cite JP Morgan lightly because they're also one of the most active traders in the paper gold markets. But even they issued a research note this week, maintaining their forecast that gold hits $6,300 per ounce by the end of 2026. $6,300. From where we sit right now, at around $5,152, that's another 22% upside that the biggest bank in America is officially calling for. Let me take a step back and give you the macro architecture here, because this is where it gets deeply important and where most of the financial media completely misses the story. There are two simultaneous forces in the gold market right now that have almost never lined up together in modern history. The first force is geopolitical catastrophe, a major Middle East war involving a direct U.S. military operation against a significant regional power, the closure of the world's most important oil choke point, and a level of global uncertainty that analysts have called the greatest strain on the post-World War II security architecture in decades. This force drives panic buying, safe haven demand, fast money flows. It creates volatility. It creates spikes like the $1 to $5,417 we saw on March 3rd. The second force is far quieter, far more patient, and in many ways, far more powerful. It's the deliberate, systematic, long-term accumulation by central banks, not just China, but Poland, Turkey, India, and many smaller nations, who are restructuring their reserve assets away from dollar-denominated holdings and toward physical gold. This is de-dollarization in slow motion. And it doesn't create spikes, it creates a floor. A rising structural floor that means every time gold pulls back, it finds buyers at a higher level than the last time. When both of these forces are operating simultaneously, the panic buying and the structural accumulation, that is historically when you see gold move in ways that look impossible in retrospect. Now here's something I want to show you that gets almost zero attention in the mainstream narrative. Let me talk about what China's private citizens are doing with gold, because it reinforces the official story in a way that's striking. The World Gold Council's China update for early 2026 revealed something genuinely remarkable about Chinese consumer behavior. In 2025, Chinese gold demand underwent a fundamental rotation. Gold bars and coins, investment-grade physical gold, rose approximately 35% to around 504 tons. More importantly, for the first time ever, investment gold overtook jewelry as the dominant form of gold demand in China. Chinese households crossed a threshold. They stopped treating gold primarily as something you wear and started treating it primarily as something you hold as a financial asset. At the same time, Shanghai Gold Exchange withdrawals in January 2026 totaled 126 tons. Chinese gold ETF holdings added the equivalent of 38 tons in January alone, the strongest start to a year on record, and assets under management reached all-time highs. Chinese gold futures on the Shanghai Futures Exchange averaged 456 tons per day in January, running 72% above their 5-year average. Think about what this tells you. The government is buying, the central bank is buying, and now ordinary Chinese citizens, saving for retirement, protecting their purchasing power against a weakening yuan, are buying too. All three levels of the Chinese economy are moving in the same direction, simultaneously. That kind of alignment doesn't happen by accident, and it doesn't reverse overnight. Let me bring in the Dubai angle here because it's one of the most underreported pieces of this entire story, and it has direct implications for physical gold availability worldwide. When the US-Israel-Iran conflict began on February 28th, one of the immediate consequences was the grounding of commercial flights out of Dubai International Airport. Dubai is not just a travel hub, it is one of the world's primary physical gold trading and logistics centers. A report from USA Gold on March 4th, citing CNBC's Mining and Metals desk, described how the Iran conflict had grounded Dubai flights, hammering global bullion supply chains and igniting what they called urgent Asian buying. The physical gold market, the actual metal that moves through vaults and refineries and customs, tightened dramatically in those first days of the conflict. When Dubai goes offline as a transit hub, gold shipments to India, Southeast Asia, and East Asia get disrupted. Dealers in Singapore were paying premiums of between $1.20 and $2.50 per ounce over spot. Dealers in Hong Kong and Japan were running similar premiums. When premiums widen in physical markets while the paper futures price is still adjusting, you're seeing a disconnect. The real-world demand for physical gold that you can hold in your hands is outrunning what the screen prices are showing you. That gap matters. And that brings me to something I want you to think carefully about because it goes to the heart of what makes this gold cycle different from previous ones. The gold market, as most people interact with it, is largely a paper market. The COMEX in New York, where gold futures are traded, handles a notional value of gold that is many multiples larger than the physical gold that actually exists in COMEX-registered vaults. Most of the people who buy gold on the futures market never intend to take delivery of actual metal. They're trading a contract, a promise, a number on a screen. For most of the last 50 years, that system worked fine because the paper price and the physical price moved in reasonable lockstep. But what we've been watching build, slowly, quietly, and now with increasing urgency, is a world in which the entities that actually want to hold physical gold are growing faster than the physical supply can accommodate. Central banks don't hold paper promises. They hold bars, in vaults. And when 74.22 million ounces of that demand comes from one country's central bank alone, and that country has been on a systematic dollar reduction program for years, the foundational assumption of paper equals physical starts to look increasingly fragile. I'm not saying COMEX breaks next week. I'm saying the system is under pressures it wasn't designed to handle, and the people who understand that are the ones buying physical metal, not futures contracts. Let me now zoom out and show you the historical template, because this is the part that truly puts everything in perspective. When the British Empire was at its peak in the early 1900s, the pound sterling was the world's reserve currency. Britain held vast gold reserves. And then, over roughly 3 decades, punctuated by 2 world wars and enormous debt accumulation, the pound gradually lost its reserve status to the US dollar. During that transition, the nations that had quietly accumulated gold emerged with real, durable wealth. The ones that had been holding pounds discovered that paper promises don't always survive the transitions of power. Before that, the Dutch Republic ran global finance through the 1600s. Their currency, the guilder, was backed by gold reserves held at the Amsterdam Exchange Bank. When the Dutch Empire overstretched and their reserve backing became questionable, capital fled to harder assets. The pattern was identical: debt accumulation, currency debasement fears, and a flight to gold by those who saw it coming. Now look at the United States today. The national debt is approximately $36 trillion. The annual interest payments on that debt recently crossed $1 trillion per year, more than the defense budget. The Federal Reserve, as of right now, has a 95.6% market probability of keeping rates unchanged at its next meeting, with only a 4.4% chance of a cut in March, according to CME Group data. Meanwhile, oil at $120 a barrel is generating inflation pressures that make rate cuts politically and economically treacherous. The United States is not collapsing. Let me be very clear about that. But it is in a period where its monetary credibility is being stress tested in ways that haven't happened since the early 1970s. And the nations watching that stress test most carefully, China foremost among them, are drawing a very specific conclusion about what to hold. Now let me get specific about what all of this means practically, because I don't want to leave you with just a macro argument. I want you to walk away from this video with some concrete things to think about. First, and this is not financial advice, I'm not your financial advisor, and you should always do your own research and consult with a qualified professional before making any investment decisions. But here's the reality of where we are. Gold has appreciated roughly 75% in the last 12 months, 64% in 2025 alone, 23% already in just the first 2 months of 2026. By any historical standard, that is an extraordinary run. It raises a legitimate question about whether you're buying at the beginning of something larger or near a top. Here's how I'd frame the answer using the data we've covered today. The structural case, central bank buying, de-dollarization, Chinese household demand rotation, those are not trend-following stories. They're driven by policy decisions that operate on decade-long timescales and don't reverse because of a 10% price correction. JP Morgan calling $6,300 by year-end isn't based on a Middle East war lasting forever. It's based on those structural drivers persisting, regardless of how the Iran conflict resolves. The tactical case, based on geopolitical risk, is more volatile and less predictable. If there's a ceasefire, if Iran's oil exports resume, if the Strait of Hormuz reopens, you could see gold give back some of its conflict premium. That kind of pullback could take gold back toward $5,000 or even $4,800 before the structural buyers step back in. The second thing I'd flag is the currency angle, specifically as it relates to the dollar. The US dollar index has been retreating from a 3-month high this week. A softer dollar makes gold less expensive for holders of other currencies: euros, yen, yuan, rupees, which expands the pool of potential buyers globally. If inflation from oil prices pushes the Fed into a corner where they can neither raise rates aggressively nor cut them, the dollar faces a credibility squeeze that historically has been fuel for gold. Third, watch silver alongside gold. Right now, USA Gold data shows silver trading at $82.55 per ounce as of this week, with the gold to silver ratio sitting at approximately 62.1. Historically, when gold leads a bull cycle, silver eventually follows, and often moves faster in percentage terms once it catches up. A ratio of 62 is not extreme by historical standards. It's been as low as 30 during past precious metals bull markets, but it does suggest silver hasn't yet fully repriced relative to where gold is trading. Fourth, pay attention to gold mining stocks. Newmont, Barrick, Agnico Eagle, and others tend to lag the spot price on the way up and then catch up rapidly. When gold is running like this, mining equities can be a leveraged expression of the thesis, though they also carry operational risks that physical metal doesn't. Fifth, keep your eye on the Shanghai Gold Exchange withdrawal numbers. Those monthly figures from China are one of the best real-time indicators of physical demand. When SGE withdrawals stay elevated, even as prices rise, it tells you the demand is structural, not speculative. The January 2026 number was 126 tons, robust by any measure. Sixth, watch the PBOC monthly reserve updates. They release data on the first Saturday of each month. Today was one of those days, and it confirmed the 16th consecutive month of purchases. If they ever pause again, like they did in May 2024, that's a meaningful signal worth watching. And seventh, keep an eye on COMEX registered gold inventories and the delivery data. As the gap between paper gold outstanding and physical gold available for delivery tightens, it adds structural support to prices that doesn't show up in the mainstream analysis. Let me bring this all the way back to where we started. 74.22 million troy ounces. The People's Bank of China, as of this morning, has been buying gold for 16 consecutive months without pause. They now hold a physical gold reserve worth approximately $384 billion at today's prices. They're doing this in the context of a global environment where a Middle East war has disrupted energy supplies, threatened the world's most critical shipping lane, and sent safe haven demand surging. And they're doing it as Chinese private citizens have simultaneously crossed a historic threshold, buying more investment gold than jewelry for the first time ever. Gold closed the week at approximately $5,152. It has a record high of $5,602.22 set on January 28th. JP Morgan is calling $6,300 by year-end. The structural case is central banks buying at a pace unseen in decades. The tactical case is a live war with genuine consequences for global energy and inflation. Both forces are pointing in the same direction. Now, none of this means gold goes straight up from here. Markets don't move in straight lines. There will be corrections. There will be days when the dollar surges and gold gets hit. There will be moments when a ceasefire headline takes $50 off the price in an hour. That's how bull markets work. The question isn't whether those pullbacks happen. The question is whether the underlying structural case remains intact when they do. And right now, based on everything I've shown you today, I believe the answer to that is yes. The nations that accumulated gold before the British pound lost reserve status didn't do it because they had perfect timing. They did it because they understood the long arc of history and what happens when debt burdens become unsustainable and paper promises lose their credibility. The central banks buying gold today, 16 consecutive months for China alone, are making the same calculation. And they have analysts, economists, and data resources that make every retail investor in the world look like they're flying blind by comparison. I'm not here to make your decision for you. I'm here to show you the data and let you draw your own conclusions. Remember, this is not financial advice. Always do your own research. Always consult a qualified financial professional before making investment decisions. What I've shown you today is documented, verifiable, public information. Drop a comment below and tell me this. Do you believe the PBOC's official purchase numbers tell the full story of China's gold accumulation? Or do you think actual buying is significantly larger than what's being officially reported? I read every single comment on this channel, and I genuinely want to know your perspective because it shapes what I cover next. There are some fascinating threads around China's off-book gold channels, their mining output, and their domestic production numbers that we haven't even touched today. And whether to go deeper on those depends on what the community wants. If you found today's breakdown useful, 16 months of PBOC buying, the Middle East war connection, the Dubai supply chain disruption, the structural versus tactical case for gold, share this with one person who needs to see it. That's how this community grows. Hit subscribe if you haven't already, and I'll see you in the next video where we're going to pull apart what happens to gold, and to the dollar, if the Iran conflict expands into a broader regional war involving more nations. The data on that historical scenario is genuinely alarming, and I want to walk through it with you properly.